Welcome to the deep dive, where we cut through the noise to find what truly matters. Today, we're taking a closer look at the unaudited standalone financial results for Honeywell Automation India Limited. This is for their first quarter of fiscal year 2026.
That's right. And this deep dive, it's based directly on the company's own official filing. The one submitted to the National Stock Exchange of India, BSE Limited. It's dated August 1st, 2025. That's the actual day their board approved these results in Pune. So really fresh data.
Right, straight from the source. So our mission for you, the listener, is pretty clear. We're going to unpack the raw numbers from this filing. This covers the quarter that ended June 30, 2025. We'll explore what these figures really tell us about how the company's performing, and importantly, make some direct comparisons to previous quarters, helping you sort of pinpoint the key takeaways.
Exactly. And just to be clear, our goal here is simply to convey the factual content. The trends we're seeing right there in these official documents. We're not adding any external commentary or speculation. It's really about letting the numbers speak for themselves. And we'll guide you through what those numbers seem to be saying.
Okay, sounds good. Let's unpack this then. We've got the statement of unaudited financial results for Q1 FY26 right here. Where do you think we should start?
Well, let's start right at the top line. Revenue from operations. Makes sense, right? So for this quarter, the one ending June 30, 2025, Honeywell Automation India reported revenue from operations of $11,831 million.
$11,831 million. Okay, how does that stack up?
Well, if we compare it to the quarter just before, ending March 31st, 2025, that was $11,145 million. So, we're seeing a pretty solid increase quarter over quarter.
Okay, growth from the previous quarter. What about year over year?
Right, looking back to the same quarter last year, June 30, 2024, the revenue then was $9,604 million. So comparing this $11,831 million to that $9,604 million, that's quite a notable year-over-year increase in revenue, a significant jump, really. And just for completeness, the total income for this Q1 FY26 stood at $12,249 million.
Okay, so the top line picture looks, well, pretty robust. Strong sales, maybe gaining market share. But here's where it often gets really interesting, right? Let's look at profitability. Is the company actually managing to convert that impressive growth into, a healthier bottom line?
That is the critical question. So let's look. For this quarter ended June 30, 2025, the profit before tax, that came in at $1,680 million. And the profit for the period, that's your net profit, was $12,246 million.
$12,246 million net profit. Okay, wait a second. You just highlighted really strong revenue growth, both quarter over quarter and year over year. But that profit number, $12,246 million, it seems to tell a different story. What's your immediate take?
Yeah, that's exactly what jumps out. What's fascinating, or maybe concerning depending on your perspective, is that this Q1 FY26 net profit of $1,246 million, it's actually lower than the previous quarter, the one ending March 31st, 2025. That was $1,399 million.
Lower than the last quarter.
And it's also lower than the same quarter last year. June 30, 2024 reported $1,365 million. So, yeah, this definitely raises an important question. What's impacting the bottom line despite that top-line growth?
Right. That's the core puzzle we need to dig into. If revenue is climbing but profit is falling, it points directly towards the expense side of the equation, doesn't it?
Exactly. Let's look at expenses. The total expenses for Q1 FY26 were $10,569 million.
Okay, $10,569 million. How does that compare?
Well, it's up from $9,709 million in the previous quarter, Q4 FY25. And it's up significantly from $8,206 million in the same quarter last year, Q1 FY25. So expenses are definitely rising.
So higher expenses are eating into that higher revenue. Can we break that down a bit? Where are the pressures coming from?
Yes, let's connect this to the bigger picture of profitability. We see a substantial increase in the cost of materials consumed. That hit $6,663 million in Q1 FY26. Compare that to $6,009 million in Q4 FY25. And look at this, only $4,401 million back in Q1 FY25. That's a really significant jump year over year in material costs. That's definitely a major factor here. Wow, yeah, from 4,401 to 6,663 million in a year. That's huge.
Yeah.
What else stands out in the expenses?
Another key expense line item is employee benefits expense. That also increased. It went up to $2,169 million in Q1 FY26. That compares to $1,785 million in Q4 FY25 and $1,841 million in Q1 FY25. So employee costs are also contributing to the pressure.
Okay, rising material costs, rising employee costs. Anything else notable on the expense or inventory side? Well, we also note the changes in inventories of finished goods, work in progress, and stock and trade line. It shows a negative figure, 380 million. Now, this implies a reduction in inventory, maybe sales exceeding production during the quarter. Interestingly, it was the same negative 380 million in the prior quarter, Q4 FY25, but it was different back in Q1 FY25 where it was a positive figure. So some consistency quarter to quarter there, but a change from the year before.
Got it. So higher revenue, but squeezed profits due to rising costs, particularly materials and employees. What does this all mean for the shareholders then? Let's check the earnings per share, the EPS.
Right. The bottom line for shareholders, the basic and diluted earning per share for Q1 FY26 is reported as 140.95.
140.95. And how does that compare?
Well, it compares to 158.26 in the previous quarter, March 31, 2025. And it compares to 154.34 in the same quarter last year, June 30, 2024. So as you'd expect, the lower EPS for this Q1 FY26 aligns perfectly with that reduced net profit we discussed, despite the revenue increase.
Makes sense. And the share capital itself, any changes there?
No, the paid-up equity share capital remains consistent at 88 million, and the face value per share is still 10. So no structural changes there impacting the share count.
Okay. It really is a classic case, isn't it? Fantastic sales growth. But if your costs run ahead of it, that growth doesn't necessarily translate to profit. This report really highlights that tension.
Yeah.
What about the company's overall structure or the review process for these numbers?
Good points. The company's notes confirm it operates in just one primary segment, automation and control systems. This is reported according to the Indian accounting standard in AS 108 on operating segments. It also states clearly it doesn't have any subsidiary or associate companies, so it's a standalone entity in that respect.
And the review. Who looked over these unaudited results?
The unaudited standalone financial results for Q1 FY26 underwent what's called a limited review. This was performed by Walker Chandiok & Co. LLP, the statutory auditors. Their conclusion essentially states that, based on their review, nothing came to their attention suggesting the statement wasn't properly disclosed according to accounting standards or contained any material misstatement. They also mentioned relying on prior reports by a different firm, Deloitte Haskins and Sells LLP, for the comparative figures from earlier periods. So there's continuity in the audit trail, so to speak.
Okay, so let's try and summarize this. What does it all mean for you, our listener? We've really delved into the core numbers here, and it's a bit of a mixed bag, isn't it? You've got strong revenue growth for Honeywell Automation India Limited in this first quarter of FY26. That looks good. But, and it's a significant but, there's a surprising dip in net profit and also in earnings per share compared to both the last quarter and the same quarter last year. And this seems pretty clearly influenced by those notable increases in key expenses we talked about, especially cost of materials and employee benefits.
Absolutely. I think this deep dive really underscores the importance of looking beyond just the headline revenue figures. While that top-line growth is definitely positive, you absolutely need to understand the cost structure underneath and see how that structure impacts the bottom line to get the full picture.
Right. We've seen exactly what was reported in these official documents. No spin, just the figures as presented by the company and reviewed by their auditors.
So maybe for your final thought, something to mull over, consider this. How might a company like Honeywell Automation, which is focused solely on this automation and control systems segment, how might they strategically manage those rising material and employee costs going forward? Specifically to try and translate that strong revenue growth we saw into more proportional profit growth in future quarters, especially given these Q1 FY26 figures we've just walked through. It raises an important question about cost control and margin management for you to think about.